Hi, everybody. This is Peter Schiff. It is Tuesday, February 11th, 2014. On Friday, we got the highly anticipated January jobs report, and a lot of economists were eagerly anticipating this number. They were very optimistic. People were looking for 190,000. Some were looking for more than 200,000 jobs created. Of course, more importantly, economists were sure that we were going to get an upward revision to the December number, which originally only reported 74,000 jobs being created. Everybody was confident that that was an outlier, an aberration, and it would be revised sharply upward in January. So what did we get from the government for the January numbers? Well, not only did we disappoint in January, we only created 113,000 jobs in January, well below the consensus estimate, but we only revised the December number up by 1,000 jobs, from 74,000 to 75,000. So hardly an aberration. It looks like the number stuck, and now we have another bad number in January. Of course, now the economists are attributing all the bad numbers, both in December and January, to the weather. After all, it was just too cold in January or December for employers to hire anybody, so they postponed all their hiring until the weather warms up. I'm sure there's all these employees that people are dying to hire, but they just can't do it because it's too cold. And when it warms up, well, we're going to have all these jobs created that otherwise would have been created. In fact, economists are telling us that if it was only warmer and not quite as much snow, that we would have hired 200,000 people in each of those months. In fact, they're already preparing for a weak February because, after all, it's probably going to be cold in February as well. But as the weather warms up, they expect the prospects for the economy to warm as well. This is all wishful thinking. This is all living in a delusion. Wall Street continues to be fixated on this story of a robust economic recovery that just does not exist. And so in the meantime, everybody is going to reject any type of information, economic data, that doesn't validate this scenario. You know, rather than looking at the economic glass as half empty, they always want to see it as half full. But the reality is the glass is empty. There's nothing in the glass at all. Yet they're trying to pretend that it's overflowing with water. Now, the markets actually rallied last week and continued to rally today with Janet Yellen testifying, and I'll get to that in a minute. But to me, it looks like the market is rallying on the bad news because the market is remaining hopeful that the Fed will back off from its taper talk, suspend the QE, which I believe is going to happen. Now, until the Fed comes right out and says that, I think the market will still be on the defensive, so the rally may run into some resistance until the market gets what it wants. Of course, the gold market is actually leading the way. Gold was up quite a bit today as Janet Yellen spoke. In fact, thus far in 2014, gold prices are up about 7%, while the stock market is lower. We're off the lows of the year, but we're still in negative territory. While gold is up 7%, gold stocks are up about 20%. But Wall Street is still extremely skeptical of gold's rally. Everybody expects that this rally is a head fake, that it's going to reverse, and that gold is still headed much lower for 2014. I think a lot of people that are anticipating lower gold prices are going to be surprised. In fact, in my estimate, I think the main selling in the gold market is coming from the short sellers who are selling gold that they don't even own. I believe most of the speculative longs have long since left the market. They were flushed out in the second half of 2013. I think all you have now is short sellers, and ultimately they're going to be forced to buy back that gold, only I believe at much higher prices, as economic reality ultimately rears its ugly head and this fantasy of a recovery fades and the reality of indefinite QE replaces it. Speaking about indefinite QE, let me move on and talk about Janet Yellen's testimony today. This is the first time that Janet Yellen has testified before Congress. This is the semi-annual testimony. She spoke in front of the House today. On Thursday, she will speak in front of the Senate. I'm going to talk about some of the points that she made today. I'm going to be going over this in more depth in my radio show. So again, if you want to get more of my feedback, not only on Yellen and what she's testifying, but on what's going on in the economy and in the markets, make sure to listen to my daily show, The Peter Schiff Show, at schiffradio.com, because you're going to get day-by-day updates on what's going on, not simply on these video blogs. But in her prepared testimony, Janet Yellen certainly stressed continuity with the programs under Ben Bernanke, as if continuity is a good thing. It's not. If you're continuing bad policy, then it's a bad thing, and that's exactly what she is doing. In her prepared testimony, she did stress her commitment to continuing to follow through with the taper timetable that was established by Ben Bernanke. Of course, she did qualify that by repeating that it is data dependent, meaning that if the data changes, the Fed will change as well. I think the Fed knows the data is going to change. They're just waiting for the excuse to do what they're intending anyway, which is to call off the taper and ultimately reverse it by increasing the amount of monthly QE, not diminishing it. Another thing that she committed to in her prepared remarks was to maintain a 2% inflation rate. She mentioned that it was still below her goal, but she was confident that inflation would rise back up to 2%. So those of you who were worried that prices wouldn't rise faster, nothing to worry about. The Fed is on the job, and they're confident that your prayers will be answered and that prices will, in fact, rise even faster in the future than they are rising right now. So you got that going for you. But what Janet Yellen said is that once inflation hits 2%, she's going to make sure that it doesn't get too far above that or too far below that. How exactly she does that, I don't know. I mean, how do you fine-tune the inflation rate to that degree? And when did central bankers decide that 2% inflation is the ideal amount? That if it's below that, it's not enough, and it's above that, it's too much. Where did this number come from? I mean, they pulled it out of a hat. The reality is, the lower the inflation rate, the better. 2% inflation is not ideal. 1% would be better than 2%, and 0% would be better than 1%. And if prices were to fall by 1% per year, that would be preferable to prices remaining stable. The Fed wants to create inflation, not because it's good for the economy, but because it's good for the government that needs it and for the asset bubbles that also need it. Now let me get into the more interesting part, or some of the interesting aspects of her testimony, and that is the Q&A that follows. Now, one of the points that Janet Yellen made was that the goal of Fed policy has been and continues to be to encourage spending, right? As if a lack of spending is the reason our economy is in trouble. It's actually the reverse. We have too much spending, and any monetary policy that is designed to get us to spend more is going to be counterproductive. I mean, after all, the Fed is trying to fight the aftermath of the financial crisis, the bursting of the stock market bubble, of the real estate bubble rather, and the ensuing financial crisis. But what caused that crisis? Spending. Sure, you can say it was the debt that caused the crisis. We had too much debt. But why did we have so much debt? It was to pay for all of the spending. Some of the money was spent buying assets, like real estate. Other money was spent buying consumer goods. But we spent a lot of money that we didn't have, and we borrowed the money to finance it. Right? So it was the spending that drove the debt, which inflated the bubbles, which caused the financial crisis. Of course, all of that excess spending financed by debt was made possible by the Fed and its cheap money policies the very cheap money policies that Janet Yellen is now bragging about pursuing to try to solve the problem that was created by the same policies that they're using to solve it. What we need in America is not more spending. We need less spending. We need more capital investment. We need more production. But all of the things that we need are being inhibited by the Fed's policy, while all the things that we don't need are being encouraged, which again is why all of this policy is counterproductive, why it is not leading to genuine economic growth. It is simply reflating the busted bubbles, not only in the real estate market, but in the stock market. See, this time around, we've got a stock market bubble, we've got a real estate bubble, and a bond market bubble, all happening at the same time. I'd say the main difference, though, between the bubbles we have now and the bubbles that already burst is that these are being enjoyed by fewer people. A lot of the people, individuals that own stocks in the 1990s, they're not in the stock market now. They lost all their money in the stock market. You have a smaller number of people that are participating in the stock market. That's why if you look at ratings, for example, on CNBC, they're at record lows. You don't have the big audience that you had in 1998 and 1999 because the investor, the retail investor, is not in the market the way they were back then. So you're not getting the impact, the short-term impact on the economy that we had from that stock market bubble because fewer people are benefiting. That's why you see, we had the worst Christmas ever shopping season because people don't have the stock market wealth that they had back in the late 1990s. The same thing with the real estate bubble. This real estate bubble is not benefiting Main Street. Home ownership rates are at a generational low. It's hedge funds and private equity funds that are benefiting from inflated real estate prices this time. So it's not translating into the type of consumer spending we had in the prior real estate bubble. It's concentrated at the top, but it's still a bubble and it's still doing tremendous damage to the U.S. economy. Interestingly enough, during the Q&A, Janet Yellen was asked several times, if she saw any bubbles brewing in the U.S. economy, if there was anything that was worrying her. Now, I don't know why they even bothered to ask her. After all, she was clueless to the past bubbles. She didn't see any problems before. She couldn't see the housing bubble. So, why should she know if there's a bubble now? So why is anybody asking her? And why didn't Janet Yellen say, what are you asking me for? I got no clue. I was blind last time, so why do you expect me to see any better this time? No, Janet Yellen, once again, just as confidently as she did back in 2006, said that there are no bubbles anywhere. She doesn't see any problem. She doesn't see excess debt anywhere. She doesn't see excess valuations anywhere, despite the fact that we've got 0% interest rates, despite the fact that we're doing all this quantitative easing, right? She doesn't see any problem. She doesn't see any bubbles. I mean, she acknowledges that her cheap money policies and her quantitative easing have resulted in higher asset prices than would have been the case absent the Fed's intervention. Doesn't that concern her? Especially when she's threatening to take away those funds, take away the source of those inflated asset values, and she's not worried that they might come back down to earth if the Fed removes the QE. In fact, several of the congressmen were asking her about the effect that the low interest rate policy, zero interest rate policy, is having on the elderly who are living off of their savings and who don't have any income and who are now maybe speculating in the stock market when they don't want to. And they were asking, well, what about them? How does the Fed feel about the collateral damage in this experiment? And while she did express some sympathy for people living on fixed income, she said, well, look, this is what we have to do. Their sacrifice is for the greater good. But she did say that when the economy recovers, interest rates will go back to normal and they'll be able to clip, nice coupons again. Well, first of all, that's a lie because interest rates can never rise to normal levels because the debt is at an abnormal level. We cannot afford to pay normal interest rates on the enormity of the debt that we have. The reason that the Fed still has interest rates at zero is because that's the most we can afford. Also, to say that once the economy recovers, we'll be able to raise rates, I thought it recovered. The Fed is talking about the economic recovery. President Obama, is bragging about the economic recovery all the time. How can she say, well, after the economy recovers, then we'll raise rates? Hasn't it recovered already? I mean, if the Fed can't raise rates now, when are they going to raise them? In fact, this so-called recovery has been going on for so long that we're overdue for the next recession. What's the Fed going to do then? You know, because, of course, once we start to go into a recession, of course, they can't raise rates. In fact, they can't even lower them because they're still at zero. So she basically was lying with respect to her answer because she knows that the savers are screwed. Not only are they getting 0% interest rate, but she's stealing their principal through inflation. In fact, she lied about a number of things. Another lie in particular had to do with whether or not her quantitative easing and 0% interest rates were helping to enable the large deficits that the government is running. And her answer was no. Well, of course she's enabling them. If the Fed wasn't artificially suppressing interest rates, we couldn't afford to borrow all this money. If the Fed wasn't buying all these treasuries, the government couldn't sell them. I mean, to deny the fact that monetary policy is enabling the deficits when her policy is to monetize those deficits, that is the point of monetizing deficits. You are enabling governments to finance spending that, absent that monetization, never could have taken place. But maybe the biggest of all the whoppers she told is when she was asked about why we had 0% interest rates, and isn't it, damaging part of the economy? And of course it is, right? It's her monetary policy that is so destructive to the economy. But she said that the Fed did not just arbitrarily come up with this low interest rate of zero, that it's not because of the Fed, it's because of the market. She said that the economy is weak, and in a weak economy, there aren't a lot of people who want to borrow money, and that's why the rates are so low. Well, again, first of all, I thought it was supposed to be a recovery, right? The economy is supposed to be in recovery. It's not supposed to be as weak as she's saying. I mean, 0%? I mean, we've never had interest rates at 0%. So is the Fed chairman saying that right now the U.S. economy is weaker than it's ever been, even during prior recessions? Because during prior recessions, we never had interest rates at zero, and now we're supposedly in a recovery, and according to the president, the recovery is finally real, yet interest rates are still at zero? Why is that? Well, maybe because there is no recovery, and the Fed knows it. But it's not the market that has interest rates at zero, it's the Fed. If what Janet Yellen was saying was true, if it really was market forces that were responsible for the low interest rates, they wouldn't have needed quantitative easing. The only reason the Fed did quantitative easing is because the Fed wanted interest rates to be lower than where the market was setting them. And of course, the other reason that rates are low is because the bond market knows the Fed is buying, that the Fed is not letting them go up. So the whole market is manipulated. What we need in this country is higher interest rates because we need to reward savings. We need to encourage savings. And we need savings to be invested productively in plant and equipment to grow the economy and provide good-paying jobs. What we have now is a debt-fueled bubble where all the credit comes from the Fed and none of it goes into the real economy. It all gets gambled with on Wall Street, and none of this is creating legitimate wealth. Yes, it is enriching some people on paper, but it's bankrupting a lot of other people in reality. Ironically, several of the congressmen asked Janet Yellen what she wants Congress to do, what they can do about the unemployment problem, right? They asked specifically for her advice. Some people said, what about, youth unemployment or minority unemployment, African-American unemployment? What can the Fed do to help that situation, or what would they advise Congress to do? Of course, the Fed can't fine-tune their monetary policy specifically to help one particular ethnic group, right? But she didn't want to say that. But of course, she had no answer. Every time they asked her, well, what can we do? She just remained silent. She said, well, what we're doing is we're trying to grow the economy by printing money and encouraging spending, which isn't going to grow anything except the debt. All she's doing is providing the economy with inflation, which is making the burden of the unemployed and the employed even worse. But what's more important is what she didn't say. Why didn't she just say, well, get rid of the minimum wage? I mean, you're talking about high rates of youth unemployment, the single biggest factor that is preventing young people from getting their first job, right? And then acquiring the skills that they need to get a better job and to earn more money is that minimum wage. But she couldn't even come up with that. She couldn't even advise Congress to get rid of the minimum wage because Janet Yellen can't do anything about it. Although, in a way, that is Janet Yellen's policy, because by creating inflation, she is in effect lowering the minimum wage, because wages are losing value because our money is losing value. And if we get enough inflation, that will significantly reduce the minimum wage. The problem is the government is increasing the cost of labor faster than inflation is reducing it. That's why we're not making a dent in the unemployment rate. And of course, Congress is threatening to make the situation even worse by increasing the minimum wage in addition to increasing other costs associated with employment. That's about all I've got to say for now. Remember, I'm going to continue to talk about Janet Yellen's statements. I'll analyze them, and I'm going to be going over what she says and the Q&A that we're going to get on Thursday on my daily radio show, The Peter Schiff Show. So again, don't forget, schiffradio.com. Mondays through Fridays, 10 a.m. to noon is the live show, but you can tune in anytime you want and listen to the feed. That's it for now. Take care, everybody, and bye-bye.